Life insurance has been called the fourth pillar of Americanism. We're going to talk more about that today. You are listening to Wealth Talks with the McPhees. I'm John McPhee, and Ben is here in the studio with me today. Welcome to the show, Ben.
Thank you very much.
You know, we were looking at an article online on a popular investment news and informational website. It's a very popular website. If I mention the name, a lot of you would know it. But we ran across this article not too long ago, and it was talking about life insurance. The only problem with the article is it was factually inaccurate. And so Gracine, our sister, she got to looking at the article, decided to write an article that will be helpful, cover some of the similar points, but actually be factual and helpful for people. So the article on our website now, 5 Ways to Use Whole Life Insurance Cash Value, provides some great information about the different types of life insurance and how you can use the cash value that builds up in whole life insurance. We're going to talk a little bit about that today. Why would people buy life insurance in the first place, whether it's term, whole life, or anything else, Ben?
Well, I'll talk about that, but I just want to say one of my favorite quotes is by Abraham Lincoln, a former president of the United States who did some incredible things, especially for civil rights. You know him. And this quote reads, "Don't believe everything you see on the internet, even if there's a picture to go with it," attributed to Abraham Lincoln. And that is just as inaccurate as some of the information that's on the internet. I know exactly which article you were talking about because I read that article too. And this article by Gracine that we're looking at right now is definitely better. It hits all the points, and I think more besides, but better than that, it's correct. So to answer your question about why people would buy life insurance to begin with, we are always taught as life insurance agents that life insurance is number one for income replacement. Let's say the income earner of a family were to die, then obviously that family is without income, assuming the other parent is staying home. Or let's say both parents are working and one of the parents were to die, that family is suffering an income loss. They need income replacement to be able to continue that standard of living, maybe to continue to afford private school, childcare, food, clothing, necessities, mortgage payments, utility bills, that kind of thing. So primarily, and first and foremost, life insurance is to take away some of the financial awkwardness that would happen without it.
Yeah, that's the biggest thing. Income replacement, but also just the awkwardness that goes with losing a family.
And I met a guy recently, which unfortunately, this thinking is kind of rare now. He's a little bit older than I am, and he has $4 million of coverage on his life. I think the guy is early 30s right now. But he also has 3 children and a wife. So he has $4 million of term coverage, and he told me that his thinking behind this was that if he were to die, his wife could take the $4 million death benefit. She could put it out at interest in an account that's earning 2 to 3% interest, which is probably realistic these days. Very low interest, which is why he has so much coverage, because then he believes that she could live off the interest alone and never run down the principal.
Interesting.
Brilliant planning. That's what life insurance is designed for, to be able to take care of his family, even if he is no longer able to.
Yeah. And a lot of people, when you think about $1 million in today's world, it's not going to go all that far.
I'm constantly shocked, John, that people that call in with next to no coverage, like $50,000 through work, $150,000 through work, whatever it may be, and they don't own any individual life insurance. And if they do, maybe it's a $100,000 policy, $200,000 policies. Once in a while, we'll see a $500,000 policy, $1 million policy. Very, very occasionally, we'll have people that have over $1 million of coverage on their life, maybe 2, 3 million. 4 million is getting very rare. Anything larger than that, very, very, very far and few between. And it doesn't have to be that way, I don't think, because life insurance is so inexpensive.
It is inexpensive. So it's there for grieving families. It's there as income replacement. It's there to keep the home, keep the business alive, keep food on the table. And really, when we think about it, life insurance, for the people that use it to plan wisely, they become the true heroes in a story when something bad happens.
Yeah. Just going back to the cost of life insurance too, like it doesn't really cost that much at all.
So how much does a term
I
life
did this
insurance
thing
policy cost?
maybe a year ago. I think it was somewhere around a year ago, and it was kind of fascinating because I wanted to know, okay, how much would a million? I think I did $1 million of coverage because my goal was for a family of four, and I had the mother as a stay-home mother, uh, so she could take care of the home and manage the children, and I had the dad earning the income. So I put the coverage on the dad, and I just did term insurance. I think this guy was in his 40s that I ran the numbers on, and I chose a local property, and I made the house have 4 bedrooms.
Okay.
Actually, yeah, I think it was 5 bedrooms because I did one for the parents, one for each of the kids. Yeah, this
Okay.
is correct. Then I took the local college, UNLV, and I said, okay, what would a 4-year education or 2-year education be at the UNLV local college? And what would it take to pay off the mortgage on this 5-bedroom house?
Okay.
So that's how I determined the amount of life insurance that he should carry. And then I did a cost analysis on that. And I found out that to get the coverage to pay off the house completely if he were to die and take care of all the college education for all 4 kids, that he would only have to spend the price of a Starbucks coffee. What's the middle size?
I don't really know. I don't know on the Starbucks
I
coffees.
don't know. If we were coffee drinkers,
So
we'd
it's
probably
the
know.
middle size
The
Starbucks.
middle size. It's not the little one. It's not the really big one. It's the one in between.
Interesting.
And a slice of banana bread. So for that cup of coffee and the slice of banana bread every day, never have to worry about that. Him or his wife would never have to worry about the house being paid off or the kids' college being paid for if he were to unexpectedly die.
Wow. So that's term life insurance, and term life insurance is really good.
It's not that expensive.
Cheap,
Yeah, it's
cheap
amazing.
death benefit, very little per day. There is another type of life insurance though, because term life insurance won't last forever, will it?
That's right. So when I say it's so inexpensive, that's true for people that are in like their 30s, 40s. You know, you can kind of relatively say maybe 50s as well, depending on what your version of inexpensive is. But you're right. It comes to a point in time where if they want to keep that coverage, the price is going to go up on it. So let's say they start out with the biggest policy, longest term they can get. Maybe it's a 20-year term that's available. And so they pay for that. But at the end of 20 years, a 45-year-old is going to be 65.
Mm-hmm.
Chances of them dying are going to be much, much higher. And so the cost accordingly is going to be higher as well. That's not affordable for a lot of people at that point. When you're talking about a premium that goes from, let's say if it's an older person, maybe $300 a month, all of a sudden it jumps up to $2,400 a month.
Nobody's paying that.
That's not affordable. Yeah. That's not inexpensive anymore. So people who plan ahead can definitely still carry life insurance, even inexpensively, I might add, even though it's going to cost a little bit more along the way, and that's whole life insurance.
Yeah, and so it's going to be less expensive over the long run, is what you're saying.
It is.
To buy the whole life insurance.
People say term insurance is cheap. Just get term. And that's true. It's cheap. But it's not as inexpensive as whole life insurance, if that makes sense, for somebody who wants to keep it for a long, long time. If somebody just wants it for 20 years and they're sure they're going to be done at that point, which I might add, nobody's a prophet, nobody knows the future, nobody's sure that they're not going to need it at that time, well then yeah, term can fit the bill. I think term is very appropriate for somebody who's getting a business loan, personal loan, mortgage, something like that, and they need to have the coverage, but maybe they can't afford the whole life insurance premium they would like. They can supplement with that.
Mm-hmm.
So they have some permanent insurance and then they have some term insurance. They can try to convert that along the way. So it definitely has its place, but I don't think it should be somebody's entire plan. They need to have permanent insurance. Because the whole thing is, people say, oh, well, I'm not going to need it at that age. Well, how do they know that they're going to need it right now? Are they going to get in a car wreck and actually need the death benefit? Are they going to get killed in an unexpected... Nobody knows. So why are they so sure that they're not going to need it at some point? I don't understand that.
Yeah. I don't either. So term and whole life insurance, that's why we usually use a combination here at Life Benefits, because the term insurance is cheap coverage. You can get the coverage that you need right now when you're young. And then the whole life insurance coverage, you get at least some of that too, so that when your term insurance goes away, you still have coverage going forward. And, most people, as they go through life, their cash flow improves. And so they can even convert some of the term insurance that they have into more permanent coverage later on. So that money is there for their whole life.
That's right. Now, term insurance for me would be really cheap right now.
Certainly would.
At my age. But I'm buying permanent insurance because I understand that I can use the cash values right now, obviously, as reserves. But over time, I understand that I'm going to spend way less on my insurance because I'm spending more now, if that makes sense.
Yes. Totally makes sense.
I buy permanent insurance.
Now we've, as we're on the subject of insurance here, we have to talk about one more type of insurance, and that is universal life insurance. And people say, well, you don't want if you don't want the fixed premiums of whole life insurance, and you want the inexpensive term insurance, then go with universal life, because then you have flexibility. This is the big selling point with universal life insurance. You have flexible premiums.
Right. They say you can adjust them up if you want to pay more this year, down if you don't want to pay as much. And the reason you might want to pay more is because that would go into cash value.
Right. So when you pay extra, then it goes into a cash account that earns either an interest rate, or maybe it's tied to the market in variable universal life insurance, or tied to an index in indexed universal life insurance.
That's the most popular one right now, the indexed universal life.
It's the most popular one. So when you do that, though, there's a very important catch. Well, two, actually. One, the first one is that all universal life insurance is based on term life insurance. So the expense will go up as you get older.
Of course, yeah.
So that you're going to have a bigger and bigger and bigger cost of insurance every year, whereas whole life insurance, that's all built in ahead of time. The second pitfall with universal life insurance is that the insurance company can change the parameters along the way. So especially when it comes to indexed universal life insurance, there are so many different options that the insurance company can change at their prerogative without consulting you, without actually changing the contract, because those things are written into the contract to begin with. Those types of contract nuances do not put you in control. They put the insurance company in control. And so when you really want to have guarantees for your future, and you want to know what you're going to have ahead of time, whole life insurance is the way to go every single time.
It is. I like to consider myself an open-minded person, at least take a look at things. So IUL is extremely popular right now. I think it's an easy sell because they can project very high numbers. Whether they reach those or not is another story, but the projections are big, and I think it makes it an easy sell, which is probably why it's so popular right now. But like I said, I like to consider myself an open-minded person, so obviously I've taken a look at contracts. Anytime I get the chance to look at an IUL, I generally take it. I look at the guaranteed values. I look at the non-guaranteed values. I call the non-guaranteed values the sales columns because a lot of people think that's where they're headed, probably because of the way the policy was pitched to them. But like you said, it's based on term insurance, and a lot of people don't know that as that term insurance increases the price, they're not necessarily going to see it right away because their bills are not going to increase for that. Instead, what's happening is it's being deducted from their cash value every time, and not everybody's paying attention to their cash value like they should. And so their cash value starts going down, 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 down. And then when most people find out what's going wrong, something's wrong with their policy, it's when their bill does increase. And at that point, it's because their cash value has run out.
And that's a little too late.
It's too late. Nobody can afford that.
Yeah.
Or nobody wants to afford that. It's ridiculous.
So when you look at the sales column, obviously the indexed universal life insurance might have higher values than the whole life insurance.
Oh, they do on the non-guaranteed side for sure. Absolutely.
Right. But what about on the guaranteed side?
Well, guaranteed side, pretty much all of the ones, I can unequivocally say all of the index universal life policies I have seen lapse at some point on the guaranteed side. Yes, it's just a difference of when they lapse. Some of them sooner, some of them later. So I always have people look at it when I'm doing a policy review or whatever for them. Look at the guaranteed side, look at the cash value and the death benefits amount, and run down that, You might have to turn a page to see it on the next page. But at some point, there's either going to be zero or there's going to be the word lapse written there in all caps. And at that point, the policies run out of guarantees. The insurance company is liable for nothing. They have to pay you nothing. They have to keep nothing in your cash account because it's gone.
Yeah. So if the market performed well, then you might still have some value left.
That's
at that
where the
time.
non-guaranteeds come in. Can you do as well as the non-guaranteeds to keep those account values high?
Yeah. And most people don't do as well as the projections.
No.
They might be somewhere in between, but why do you want to, if you're buying insurance, you're buying it for security. Why would you want to bank on something that is not guaranteed?
That's a good point. So if somebody already has their insurance and they've got permanent insurance, as in whole life insurance, or they've got a term insurance that's convertible to whole life insurance, and then they want to risk some money and see if they can keep up with the index, and they want to do that in index universal life, that's completely fine. But I don't understand why they would gamble with their coverage when there's such a significant chance that they might end up with nothing.
Mm-hmm. So let's talk a little bit here about the options that you have with cash value. Whole life insurance builds cash value. We know that. So does universal life insurance. It's a different type.
That's a good one. We should probably cover that because they're called cash value and cash value in both products, but they're completely different.
It is completely different. So go ahead. What's the difference?
So with a whole life insurance policy, like the ones that you and I buy and that we design for people, the cash value is the equity. I tell people, think of a house. When you have a mortgage on a house and you're making payments every month, you're developing equity in that home. So if you were to sell that home or take a home equity line of credit against that home, there's a certain amount of money that you could access out of the home once it was liquidated in a sale or when it was lent to you from the equity within the home on a home equity line of credit. That's similar to a whole life insurance policy. The longer you own it, the more of it that you own. With an index universal life policy, or any universal life policy for that matter, the cash value is in an account, and it's simply money that has not been used to pay for insurance yet. So if you picture just a regular bank account, and then you picture your life insurance, instead of paying money to your life insurance directly, you're effectively paying money into just this standalone bank account. Then the insurance company takes money from that account to pay for your life insurance. That standalone bank account in our example here is your cash value. That's your cash account. And whatever's not taken to pay for insurance is what your cash value is. It would be kind of interesting to talk about here why they pitch universal life insurance policies as you get the death benefit and the cash value versus why whole life insurance you only get the death benefit.
Yeah, and it depends on the type of life insurance. Because the type of universal life insurance, there's type A and there's type B. And it depends if they roll the cash value in as part of the death benefit or if the death benefit is completely standalone. If the death benefit is standalone, bought from the cash value, then you get both because they're completely different accounts.
Sure. So in our example here, that like standalone bank account where all the money goes first, whatever's left in there that hasn't been spent on insurance yet is your cash value. So of course you get that back. It hasn't been spent yet.
Absolutely.
That makes sense. And then you get the death benefit from the policy. In whole life insurance, the cash value is equity based on how much death benefit you own. So when you get the death benefit, it doesn't even make sense that you should be looking for cash value or equity because you already got the equity.
That's right.
It's part of the same thing. It's kind of like when people sell their house, they don't get the purchase price and the equity in the house because the equity is part of that purchase price.
Yeah, of course not. And everyone recognizes that with equity in the house. But when it comes to life insurance, you have to recognize that when it comes to whole life insurance, cash value is like the equity. Yeah. So if you have death benefit and cash value is the part that you can access early, of course, there's not going to be both. It's a combination account there. So good point about the cash value. Talking about the options that are available when you have cash value, you could take a policy loan from that. You could take a withdrawal. You could use the cash value to pay premiums on the policy, you could surrender the life insurance and take the cash value that's available or the surrender value. You could also use the cash value when the insurance company makes a profit and pays that back. And this is specific to whole life insurance. When the insurance company makes a profit and shares those dividends with you, then you can have those dividends go to buy what's called paid up insurance, which boosts the cash value and the death benefit even more in a whole life policy, and it creates a compounding base. So those are some of the cash value options. There's pros and cons to each of them. And here at Life Benefits, we try to make the options for using your cash value very simple and easy to understand. So
could we talk about one way somebody could use their cash value?
a policy loan is an easy way to talk about this. Let's say that somebody buys a whole life insurance policy. They build up some cash value in there and they have a business idea. Or maybe they just have an equipment purchase in their business that they need to finance. Instead of going to the bank and maybe they have to take a bank loan at 8%, what if they can go to their life insurance policy and get a policy loan for 5%? Go buy the equipment, pay it off over time just like they would have paid back a bank. And now, instead of having paid the bank interest and just having to pay interest to the bank over that time, now they can recover some of that money and they still have their life insurance policy at the end of the day.
That's pretty neat. What about somebody who is an employee, is not necessarily going to have business equipment purchases, but let's say they own a whole life insurance policy, they have cash value in that policy. Is there any benefit to putting more money into cash value whole life insurance than there is to, say, funding an IRA or more money towards a 401k? And what would those benefits be?
Putting more money into life insurance instead of one of those other vehicles?
So let's say that they decided, well, maybe I'll have higher life insurance cash value than I will have a 401k balance. Is that a good move? What would be some of the pros or the cons to that?
Well, if we take the same example as a continuation of the last one where they financed a business purchase, if you put that money into a 401k and you need to finance a piece of business equipment, you can't take a policy loan, can't take a loan from the 401k to finance a business investment. So you would have to go to the bank and get a loan. You'd have to pay interest to them. And you would hope that your money in the 401k grew during the time you did that, but you don't have control over how that money gets used in the 401k. You do with the life insurance. And when you get to retirement, it gives you more options for how you take passive income.
Okay.
That's kind of the lay down there. So there are a few different funding options for whole life insurance. You can use some of the dividends to pay premium. That's a popular one once the policy gets going. But if you're trying to grow the amount that you have in life insurance, that's not always a good idea. And we can talk about that one if you have specific questions about that in your situation. Another thing that people will often do to fund a new whole life insurance policy is maybe they have an existing universal life insurance policy. They're not happy where it's headed. They've looked at the in-force illustration like you were talking about earlier, and they see that big fat zero or the lapse in future years, and they want to get that money into something that's really going to be there for them. They can, in that situation, do a 1035 exchange and get that money over into a whole life insurance policy, and that's something that we help people with quite often.
Well, that doesn't even have to be another life insurance policy as well. I know people that have had money just sitting in the bank, me included. I don't really particularly want it sitting there. It's not really earning anything. It's not really doing anything for me. It's doing a lot for the bankers. I know that because they can lend out money in relation to that reserve that they had there that I'm letting them keep, pay me next to nothing while they're earning. But I know that if I put that money into life insurance equity, that'd be cash value in my whole life, I can still borrow against it if the need were to arise all of a sudden. But I know over time that it's going to be way more profitable for me growing in my life insurance than it's going to be sitting in the bank.
Totally.
And there's a lot of people in this boat. They have money sitting around from the sale of something, from inheritance, from savings that they've diligently done, and they don't know what to do with it. Because can you blame anybody for not trusting the market right now? not knowing where it's going.
No.
So what do they do with it? And that's one of the beauties, I think, of whole life insurance cash value as well, is you can get the guarantees of the whole life policy. You get death benefit whether you need it or not. So you can assign that however you choose. But then you also get to the access to the cash value and the cash value growth, which is going to far exceed what people are getting on interest at a bank.
Yeah. And so we mentioned business loans. People can use this money for business loans. They can use it to finance college. They can use it to finance to refinance debt that they have outstanding, pay off debt.
That's a good story because I'm thinking of a couple in California that you did a blueprint plan for at one point. And one of the questions is, should they be funding insurance, paying off debt first, or buying the policy? And you worked out the numbers, and can you just kind of give an overview of what you did there?
Yeah, that's a good point. This particular case, it really helped to show that there's a balance. If you pay off all debt before you start a policy, that's not good because you're going to be behind the 8 ball with the growth in the life insurance because you waited longer to start. Yeah, there's always going to be a compounding curve, and the sooner you can start that, the better. Now, the other side of the equation is that if you put too much in life insurance, then the compounding curve works against you on the debt interest.
Okay.
So there's a balance to this.
Yes.
There's a balance to this. But in all the situations that we've looked at, it makes sense to start at least some life insurance while you work on paying off the debt. And then once you get the debt transferred, it may take a little bit longer to pay off the debt. In this particular case that you mentioned, the couple from California, I think it took 3 or 4 months longer to pay the debt off.
That was a really exciting case, not only because of what you found with it, but because of what they did with what you found.
Uh-huh.
And it's just going so well.
Certainly. So sometimes it'll take a little bit longer, maybe 12 months longer, maybe 15 months longer. But if you look at the numbers, you will see that there's a point in time where they have more money down the road than if they'd waited to start the life insurance till after they'd paid off the debt.
I think one of the big things that came out of 2020 for me, and I know the year's not over yet, but one of the biggest realizations was time and money. Now, you hear people say all the time is money is time, that kind of thing, and I got that. But it really became real because I saw a lot of people who had a lot of money or usually had a lot of cash flow. All of a sudden, they had way less cash flow, but they had more time on their hands, with the shutdowns and all that.
Mm-hmm.
And some of the people were a little bit concerned about it, and some of the people were a little bit excited about it because suddenly they had time to do some things that they wanted. Maybe these things were going to increase cash flow. Maybe they were just things that they wanted to do as a person to be fulfilled. But that's really a critical balance that you get those things right, because like you're talking about with debt right now, if they wait and spend the time paying on debt, they may never catch up financially to where they could have been if they would spend some of that time both starting the policy that they know they want and paying off the debt at the same time. So when you go to manage money, I don't think a good money manager can manage money as effectively if they're just looking at the dollar signs, unless they're also considering the time factor and how it relates to money.
Yeah, that's important. Time and money, you have to consider those two together. They cannot be separated in our world because we're limited by both.
That's true.
Yeah. So we make this all easy for you, whether you want to use money in your life to fund college, retirement, debt payoff, businesses, maybe you even have to care for aging parents. Using life insurance can be a way to do all of those things and to do it better so that you have more money left over for your family and a legacy when it's all done. And not even that that the legacy is just when it's all done, because you have the protection while you're doing it through the life insurance.
And the memories and the experiences and everything else along the way.
It is. It's a way to do everything better.
I was talking to a guy yesterday. He said, or actually a couple days ago, anyway, a few days ago, he said that he feels right now that he is mentally in a better place than he's been in a long time. And then he shared some things that he was making progress on that he felt he had not been progressing on at all. And the progress he's making is small right now, but it's moving in the right direction. And I think for a lot of people, that's true. They see the big picture. They see what they want to be, where they want to be. But when they don't see any progress over time, it makes you sick. If you
Yeah.
just look at that.
What does the
So,
psalm say? Hope deferred makes the heart sick.
yes, but desire fulfilled is a tree of life, I think, is
I
the
think
rest
that's
of
what
that.
the rest of it.
And so you can't make it all in one giant step, but you've got to figure out what is the next step to take just so that you can make progress.
Yeah. Sometimes it's not always easy to know that next step.
It is. It can be really hard. It can be the hardest thing in the world sometimes. But then I think that's where you have to look for specialty. Whether it's somebody who knows that before, whether it's some book that you read, whether it's some video that you watch or something, some course that you take. And I know that's what we do. That's what we specialize in doing for a lot of people because they have maybe this debt, maybe this purchase, maybe the goal. They want their money working for them, not sitting in the bank.
What do they do next?
And our goal is to help them kind of know where they're going, but also where they're at right now. And then we can figure out for them, okay, this is the next right step to take. Show them what that looks like. And then, of course, the choice is theirs. Is that right for me? Is that something I want to do?
That's right. That's how we make it easy for you. You can give us a call. We can help you make your next step easier. Give us a call at 702-660-7000. You're listening to Wealth Talks with the McPhees. Have a wonderful week.